think back to what we say and it will all make a lot more sense. Now coming back to OpenAI. OpenAI is a little bit of a different story. Uber is a fast growth business, venture backable, that scaled, that experienced issues with management, board, and investor interests coming at loggerheads. OpenAI is a little bit different because OpenAI started as a not-for-profit. The vast majority of you, anyone who's a founder in the crowd, are probably not-for-profits. You're building a business that is intended to scale. Either you're building an SME that is meant to be profitable from day one, or you're building a startup that is growing to reach profitability down the line. With that in mind, your goals are quite different from a not-for-profit, which is often building for societal impact. And that's what OpenAI was initially. It was a foundation. As a result, the foundation was structured in such a way where there wasn't intended to be any space for external contributors to the board, external contributors appointed by investors. So what you ended up with was a relatively complex structure of a company, not just a holding company for the purpose of receiving investments and then the actual management company, but several independent entities, where actually the entity that was controlling the day-to-day operations of OpenAI, the entity with direct involvement of Sam Altman, the CEO, and direct involvement of the investment shareholders such as Microsoft, was not actually the executive board overseeing the foundation. And where that came to crisis was that earlier this year, the board overseeing the foundation itself didn't believe that the path towards mass commercialization of data that OpenAI was driving towards was consistent with the actual objectives of the foundation. So the board took the decision at the time to essentially recommend for the dismissal of Sam Altman as the CEO, ran against investor interests. So running back to Kaya's point, what can we learn from this? Well, number one, don't start a foundation if you're running a for-profit business. A non-profit and a for-profit are completely different entities, different parts of the economy, and they both have their own role. Number two, don't conflict the foundation board or the non-profit board with the operation of the for-profit shareholding entity. And number three, if you do go through the transition of going from a social enterprise or perhaps a not-for-profit towards a for-profit, you need to, in advance, also think of the necessary changes in governance and the management of the company, which OpenAI didn't really go through. It didn't go through that transition. It didn't go through the process of setting up a new board informed by the new strategic direction that the business took as soon as it led to or moved to commercialize generative AI models. So I think it was more so a problem of several years ago finally materializing in this year rather than something that happened just specifically this year, as perhaps some of us might think. And hopefully that leads to one or two takeaways.
Thank you very much, Mark. So before we carry on, any questions from the audience? Yes, please. Come up.
Can we get a microphone to someone in the crowd?
Good morning, everyone. Thank you so much. Sara Medina from Portugal, from SPI. Can you hear?
Can you just speak up a little bit?
Can you hear now?
Yes.
Okay. So my question, really congratulations on the panel, really excellent views. My question is about reporting. When the VC takes a management role in the board, does the reporting dramatically increases? Because I heard cases that it becomes very, very demanding for the startup or for the SME in terms of reporting that needs to provide when the VC takes a management role in the board. Thank you.
All right, reporting.
I'll take reporting, being an accountant, by background. I understand the frustrations to a certain extent, like I've said, for the startups, with more and more red tape added as they get institutional investors in particular on the board. It seems like more and more onerous requirements are required of the startups, that steer them a little bit away from the focus of operations and, actually doing the work that they, sought out to do. The reality of the situation, and I say this all the time, going back to the bottom line, is that as VCs, and any other investors, I think, I won't necessarily speak for angels, but I'll speak for institutional investors in particular. You're investing not necessarily because, you're a charity and out of the goodness of your heart. The reality is that you're running a business, right? And you've got, investors that you've got to report back to. It's returns that are being made for these people that have given you their money, and they require certain outcomes. one of the ways in which to manage, risk of an investment, for example, going to zero, or not tracking, from a target perspective where you foresee it going, from a 5-year, 7-year, 8-year horizon, whatever the horizon is for the particular, VC making the investment, is through reporting. There's a reason why the mechanism is, there in place. I think, though, a different approach needs to be taken for different stages of where a VC is. Typically when not a VC, sorry, portfolio company is. Typically when we invest, we do say that, for example, we do quarterly reporting, as well as, annual reporting, and our, annual reports are audited by auditors. And we have it as a requirement, that when we invest, we expect, as well as quarterly management accounts, and then, of course, like annual. And it's a struggle. I've seen it. It's a struggle to, get that reporting, from the startups, because again, they're busy with the actual work that they, sought out to do. But again, what one needs to realize is that, the interests of all parties, are at play here. And whilst it may seem like an, onerous red tape, additional requirements, for startups, it's actually protecting the sustainability of their vision and company overall. If you're not producing reports, it's difficult for you to see actually whether or not you're meeting the bottom line, whether or not from a headcount and a resource point of view, have we hired too much personnel? Are we leveraging too much? Is our debt highly geared? Do we need to, structure it a little bit down so we've got a better balance between debt and equity? And you can't often do that and have that kind of insight unless you're producing reports. So there has to be a balance in terms of, the kind of reporting, from a magnitude perspective you require from different VCs, for sure. I mean, from different portfolio companies, for sure. I agree with that. But the requirement of reporting overall cannot be taken away. It's important. And again, the whole objective, right, for us anyways, when we invest in these portfolio companies, we invest in believing in what the overall vision is, and invest in believing that, they can scale locally, and for us it's, globally as well. And in order to, actualize that, to get to the 30% IRR, to eventually exit, to potentially list in future one day, if that is, what is required from both parties, you have to start putting in place the mechanisms that will get you there, because investors will insist on reporting going forward. And so the sooner you start it and getting the kind of reports and the structures that are required in place, the better really. Rather than, for example, only getting your report mechanisms in place when you get to a Series C, and then at Series C having recognized that actually we are highly geared, and we didn't recognize that our debt levels were growing to such an extent, or actually we're not geared enough, and there is more room and scope, to have debt instead of just raising equity. So reporting is important, but I think the magnitude at which the reporting is required can definitely be altered from one portfolio company to another and one startup to another.
Thank you. Thank you so much, Thandi. And also thank you very much to our panel. It's been absolutely fantastic having you this morning. And I think we've learned so much from the conversation that was had. The upside of board governance, VC to startup. I think a lot of the times we think of ourselves as this superhero spaza shop that's going to do everything all by ourselves. And we are so in it to win it a lot of the time that we don't actually see what's happening around us. So being able to have people that we can be accountable to, and that sometimes do think differently, because this is something that also came up. And let's not be scared to have people who do think differently and challenge us, and our goals and our vision while we are, continuing with our startups as well. So it's not as scary. I mean, when I saw this title, I thought, ooh, because many startups kind of like the idea of being small and cozy, and this idea of a board, suits, and all sorts of things can seem really intimidating. But sometimes you need that little bit of help and assistance. So thank you so much for that. Great panel discussion for this morning. Thank you. That was Thandiwe Maqaltua and also Mr. Tlo. Thank you so much for handling the conversation, and Mark Kleiner for coming in. Thank you. We're going to move on swiftly onto our program for today. I'll release you off the stage. Thank you. We're going to move on swiftly with the program for this morning. morning. So yesterday we had quite a bit of pitching that was taking place. Thank you once again, ladies and gents. We had quite a bit of pitching that was taking place yesterday. And as you can imagine, the startups were pretty nervous because there was amazing prizes up for grabs. This time around this morning, we are going to spin it just a little bit. We've got investor pitching that's going to start taking place in the next couple of seconds. And it would be interesting to see from the investor's perspective, investor side, as to how it is they want to make themselves look good and what it is that they would change and the differences that they would make, especially in the African context as well, and the difference that they would like to make. So without further ado, our pitching stack is coming up next, and I'm going to call up on our investors who are going to be joining me. Rohan, you can come up first, and we'll see what you do have in store for us. And all the best to you and your pitching. So how the pitching usually works is that our startups usually have about 3 minutes to state their case, show us what it is that they are about, and then we have a jury that's going to ask them a few questions for about 3 minutes thereafter. So Rohan, go ahead and good luck and all the best.
Cool. All right. Okay, perfect. Well, good morning, everyone. My name is Rohan Goswami, and I'm from Nextera Capital, and we are a VC firm investing in early, which is apparently not. Anyways, yeah, so earlier this year, we launched our Fund 1, and this is a $25 million fund investing in high-impact technology sectors such as finance, agriculture, healthcare, energy access, and transportation. So I'm going to break up this focus in about two categories, our market focus and our product focus. So for our market, what does early stage mean to us? So we're investing in the seed to post-seed investment stage just because we think that there's a bit of an investment gap in that area. So what we're doing is we're coming in, investing up to $500,000 in each of our companies, helping those startups that raise their first rounds of investment and supporting them to raise their Series A and beyond. So how we do that is not only the injection of capital, but we're also going to be supporting in product development, market strategy development, and team development. So for our product, I don't know if this is going to go to the next slide, but for our product thesis, what does high impact mean to us? So we're focusing on businesses that focus on job creation and revenue growth for the entire sector. So we're looking at companies not necessarily in the frontier or cutting edge technology basis, but within the same vertical, taking a few steps back in the value chain, looking at the services and operations of those businesses. So focusing on SMEs and MSMEs. So we're helping these businesses that are not necessarily focused on those frontier technologies, but operational efficiency, profitability, and scalability across the sector. So how we do that is, or what our cutting edge is, basically, as we launched our fund this year, for the past 3.5 years, we built an accelerator called Lab8 Africa. And this was a similar thesis to Nextera Capital, focusing on high-impact technology companies at the pre-seed stage. We launched over 3 programs, worked with over 35 companies, and we grew our investor advisor and EIR base to the hundreds. So with that infrastructure, now Nextera Capital will leverage that and support our founders and our portfolio management for the companies that we'll be investing in. So going to our team, it's basically myself, as I mentioned, and Joy, who has 15 years of investment experience, and together we have around 20 years of investment experience across Africa and North America and UK. So we both co-founded Lab8 Africa. And in those 4 years, as these companies came in at the MVP idea stage, we saw a lot of these companies, okay, now they're raising their seed round. So we came together and decided to launch Next Era Capital to support their fundraising journey. So that's essentially who we are. We're focusing on those high operational efficiency businesses in the SME and the MSME space, leveraging those technologies. So if you're a founder and you resonate with our vision and you think we can help, please contact myself or the team, and we'd love to keep in touch. I'm sorry the slides weren't working, but I hope you got the gist from my presentation, but I'll take any questions if there are any. So thank you.
Thank you. Thank you so much, Rohan. How was that being on the other side of the stage?
It's kind of nerve-wracking, yeah? It's like with the whole stage and with all like these wonderful people.
Feeling
Yeah.
naked, maybe? Like
Yeah.
everybody's looking at you?
Yeah.
Like, yeah. All right. Well, thank you so much for sharing. Let's get to our jury. But before we do, let's meet our jury, because our jury is made up of our startups, right? So this is the other side of things. So let's meet our jury. And we will start on this side. In fact, we'll start with ladies first. Hella, tell us a bit about yourself.
Hello. First, thank you for this opportunity. My name is Hela. I'm Tunisian. I'm a physician, and I am co-founder of Viventis, which is a medtech startup.
Awesome. Thank you so much. Next.
Thank you very much. My name is Francis Romano. I'm from Kenya, and